everyone, welcome back to the channel. Today, we're tackling an important and complex issue, one that's shaping markets, labor forces, and broader economic trends in ways that many people don't fully grasp. Immigration policies, particularly restrictive ones, have deep ripple effects across multiple industries. But here's the thing. If you know what to look for, you can anticipate these shifts and position yourself accordingly. This isn't just about economics. It's about understanding macro and geopolitical trends, how they impact businesses and consumers, and what that means for investors. In this video, we will break it all down, not just from a financial perspective, but in the broader global context. Stick around. This is going to be a blend of strategy, analysis, and real-world implications. So, today's discussion revolves around what we're calling at Finsight IQ, the Immigration Policy Impact Trading Plan. It's a comprehensive approach to how labor shortages, rising costs, and broader economic pressures affect markets. What we're really looking at is cause and effect. How policies made at a high level filter down into the real economy, from farm workers to construction sites to grocery stores. And of course, how we as traders and investors can adapt. Let's break it down into key themes. Labor-intensive industries get hit first. Agriculture, construction, and food processing rely heavily on immigrant labor. When that labor pool shrinks, costs rise, output falls, and supply chains slow down. Inflation is the natural consequence. Fewer workers mean higher wages, which means higher costs, which means inflationary pressure in essential goods like food and housing. Consumer behavior adjusts. As inflation eats into disposable income, discretionary spending, things like retail, travel, and non-essential goods, takes a hit. Winners and losers emerge. While some sectors struggle, others thrive. Utilities, commodities, and other inflation-resistant industries become safe havens. This is why analysis like this matters. We're not just talking theory, we're talking about real shifts that impact people's lives and businesses. Let's get tactical. Here are some key stocks and ETFs that could be affected by labor shortages and rising costs. With agriculture and food production, Tyson Foods, Cal-Maine Foods, and Hormel Foods. Higher wages and tighter labor supply mean increased costs, and those margins get squeezed. With construction and real estate, home builders like Lennar Corp, D.R. Horton, and Toll Brothers face delays and higher costs for materials and labor. With consumer discretionary, Macy's, Best Buy, and Carnival Cruise Line are all vulnerable to shifts in consumer spending due to inflation pressures. ETFs to consider. Ticker MOO and CORN track agriculture, while tickers XHB and ITB follow home building. For broader market downside exposure, there's ticker SPXSA3X leveraged S&P 500 bear ETF and SQQQ, which is ProShares short of the QQQ. It's not all about shorting. Some sectors benefit from inflation and economic shifts. For example, utilities. Companies like Duke Energy maintain pricing power because people need electricity no matter what. Next, consumer staples. Procter & Gamble makes products that remain in demand, even as discretionary spending tightens. Then, of course, commodities. Gold and agricultural ETFs serve as inflation hedges and tend to perform well in volatile economic conditions. Now let's put some numbers to this. We modeled 3 scenarios: best case, likely case, and worst case. In the best case, labor shortages are partially offset by mechanization or policy adjustments, resulting in moderate inflation. In the likely case, sometimes referred to base case, labor shortages persist, agricultural output declines by 5% annually, and food prices rise by 6% annually. Then in the worst case, labor shortages intensify, agricultural output drops by 10% annually, and food prices skyrocket by 12% annually. In a world where geopolitical tensions, supply chain disruptions, and inflation concerns are already heightened, the likelihood of seeing significant economic shifts is high. In other words, you can focus less in a sense on the percentages we provided and more so on the trends. Let's look at an over a 5-year horizon forecast. For the food price index, this could rise anywhere from 15% to 76%, depending on how severe the labor shortage becomes. For agricultural output, best case, it's down 10%. Worst case, a staggering 41% decline. Construction output, declines range from 5% to 34%. Finally, wages in agriculture. This could increase by up to 34%, further stressing costs across multiple industries. These are not just numbers. They represent structural shifts that influence markets worldwide. How do we position ourselves? For best case, light put positions on consumer discretionary stocks. Small hedges with gold and inflation-resistant ETFs could be an action trading plan. For likely case, we want to increase put exposure in agriculture-heavy stocks and balance with long positions in utilities and commodities. Finally, in the worst case, aggressive shorting in home builders and food producers, heavy allocations to gold and agricultural ETFs, and broader market hedging using bear ETFs like SPXS. What we're suggesting with this trading plan is leverages the interplay between immigration policies, labor shortages, and economic dislocations to identify swing trading opportunities. By focusing on key indicators and carefully monitoring sector-specific trends, this plan aims to generate returns through targeted put options, bear ETFs, and inflation hedges. Effective risk management and adaptability will be critical as conditions evolve. To wrap this up, let's talk risk management. None of this works without a strong approach to mitigating risks. Track key indicators. Labor trends, inflation, and food supply chain reports matter more than ever. Diversification is key. Don't over-concentrate in one area. Hedging is crucial. Set stop losses. In volatile markets, protecting downside risk is non-negotiable. Adaptability is everything. Policies change, economic conditions shift, and strategies need to evolve accordingly. Thanks for watching. If you found this breakdown valuable, hit that like button, subscribe, and let's discuss in the comments.